All right. Thank you, everybody. Good afternoon. Thank you, everyone, for being here for one of the more highly anticipated events we do every year. We do a halftime report and a market update in the winter as well, every year. But these are always traditionally one of our best attended events. This year's no different. And this year, and there's always something going on, but for obvious reasons, right? The world continues to be chaotic, and that's not going to stop. But the what and the who and the where and the how is always different. And I promise this is going to be more than just an update on how what's going on over in the Middle East is impacting our investments and our markets and everything like that. But we're going to touch on that pretty substantially because that is one of the major news items from the first half of the year. So I'm letting everybody hop in from the waiting room. But again, thank you for being here. Um, Welcome to our halftime report. We're a little over halfway through the year, so it's always good to check in, not just how each of your investments are doing, which is obviously very important, but how the overall economy, the market, everything's doing together and what's caused how your accounts have been doing. And I won't bury the lead before we get started here. The markets have done really well to start the year. It's on pace, and if you've heard me say on pace before, I usually immediately follow it by saying I don't like using pace as an estimate for where we're going to be at the end of the year because there's no reason the second half of a year has to look anything like the first half. But so with that disclaimer and appropriate, I have the disclosures up as I'm saying that. We're on pace for yet another double-digit year in the stock market, which would be our fourth in a row if the year ended today, let's say. So or excuse me, if the pace from today ended, we're not at double digits right now. Anyway, that may be true. I mean, it's looking like that right now, but we don't know that. And I'm not taking that to the bank or anything like that. It's just that speaks to how well the year has started off, like the last few years have. Um, so before I dive in, I know most of you, if not all of you, know me, but Anthony Gerbi, I've been with Stein Financial Group coming up on 12 years now. Um, and I really do specialize beyond all the other things and working with all of you and helping to manage your accounts in sort of looking at the world and saying, okay, not necessarily where are the winds blowing, because I think I know better than everybody else, but collecting the information and saying, let's make the best decisions we can based off what's out there. So today, you get a little bit of a window into how I'm thinking about the world right now. Questions are welcome at any time. Feel free to pop them in the chat. There's also, I believe, a Q&A box. Yep. That if I'm not on top of, Aaron will ping me and remind and say, "Hey, somebody asked a question." So if something comes up while I'm talking and you're saying, "Oh, that's I want to hear more about that," feel free, pop it in there. There will also be some time for questions at the end. So if or certainly you can call us one on one if it's about you specifically and you don't want to ask it in front of the group. That's totally fine. So without further ado, we have an agenda here today that I want to get through. And my disclaimer before I kick this off is there's going to be charts on the screen. Now, for somebody like me, that's like my bread and butter, right? I look at charts a lot all day. But I get, and I'm totally sensitive to probably one of the reasons you're working with us is so you don't have to look at charts. That might not be something that's interesting to you. Maybe it is, and that's great. I will do my best to kind of boil down the idea that's being communicated through the chart, and hopefully by the end you'll say yes, you effectively did that. But so don't get intimidated right off the bat when we start looking at some graphs here. And speak of the devil, the first chart here is just the first half, and this is relative to the S&P 500. So let me take a step back. I know many of you know this, but some probably don't. When I'm talking about the stock market, okay, and it is what it sounds like. It is the companies in the United States that are publicly traded that we can all own shares of. That market, whether in the aggregate it moves up or down, is what we mean when we say the market went up, the market went down. But specifically, I'm going to be talking a lot about the market via the S&P 500. You can see that up in the top left corner here. Let me move my head out of the way just a minute or just a little bit. Um, so up in the top left corner it says S&P 500. So just so you know what that is the 500 largest stocks or largest companies in the stock market and how their stocks are moving. We consider that to be a good proxy for the market as a whole. Obviously, it's not the market as a whole. So it's very possible for the S&P 500 to go down one day and another part of the market to go up. And just because the entirety of the S&P 500, the index, you might call it, that's kind of the technical term for it, of that collection, that aggregate, just because that goes up or down doesn't mean every company within the S&P 500 has gone up or down that day. But we're averaging, we're aggregating. It gives us a picture of the whole without having to make me show you a spreadsheet with thousands of different stocks on it, which you'd all tune out immediately. So you're welcome for not doing that. So when I say the market or when I say the S&P 500, I'm using those terms interchangeably, even though they're not exactly the same thing. The S&P is widely used as a proxy for the stock market. In fact, the little disclosure that I'm covering up with my head down there actually says that in the fine print. So you can take it from the slide, not just from me. So let's talk about this year so far. This is since January, and you can kind of see January, February, pretty, just kind of a horizontal line with a little bit of a zigzag to it, right? Pretty calm, placid, nothing special, nothing bad. At the end of February is when the war in Iran starts. Literally on February 28th, I believe, is when it started. Then it was the last day of February this year because it's not a leap year. So, March, the market goes down. Now, many of you probably noticed that on your statements for the first quarter, which go January to March, and you caught the March period where everything was down. Definitely true, definitely happened. The market was down about 8% at its worst point, which is not crazy at all. I know the headlines were really all over the place and people were saying, well, what's going to happen here? And by the way, I am going to talk about politics to an extent without getting political. That might sound like an oxymoron, but I think I can thread that needle. But um, when the war started, it's like, okay, where's this going to go? Is this going to be ratcheted up and further escalate? Is it going to be, now this was kind of a weekend deal, and it really wasn't either of those, right? It's as most things are, the truth ended up in the middle. But by the basically about the beginning of April, we started to get clarity on, okay, where did the parties want this to go? The initial attacks on Iran had happened already, and we were starting to see, okay, they want to try to negotiate something now. Now, it's July 14th, and they've really not negotiated much yet. I mean, they've announced the deal, and then the deal's off, and then there's a ceasefire, and the ceasefire's off, and then the strait's open and the strait's closed. And frankly, we're going to look ahead as part of this. I think that's going to continue for the short term, not the long term. I don't think we're going to be sitting here 2 years from now and I'm going to be able to say those same things by any means. But in the short term, I think that probably continues. But just look at the line here. I know it's got these bubbles that tell you, some of the checkpoints along the way, but the market hits its bottom in April. And then basically since then, it's been pretty darn good. It exceeded where it was to start the year, right? And it's certainly jumped up a lot from that low point in April. So if I just told you we're kind of in this cycle where it's like it's on again, off again, on again, off again. Well, why is the market just going up then? Why wouldn't the market go up and down and up and down? And I think the answer is most people, the market included, believe that at some point here, and it might be a negotiated thing, it might just be, hey, everybody's sick of this and we're kind of ground to not like a literal stalemate, but nobody wants to go any further. It seems like the resolution that the market expects right now is that eventually the bombs are going to stop dropping. The strait is going to be open one way or another, and we're going to go back to this sort of uneasy tension between the countries rather than open hostilities. That seems to be what the market's betting on. Now, neither you nor I know for sure that that's what's going to happen, but we're talking probabilities here. And that's, I think, why the market started to recover in April. That was when they first started putting a deal on the table. And it was a good indication that, okay, the administration, the US, is not seeking a total destruction of Iran, a potentially a total regime change, although I think they would have liked that. It doesn't seem like that's actually going to happen, a total change. And I'm not trying to parse the conflict because we could spend an hour just talking about that. But essentially, what I'm saying is the market's got wind that they want to settle this thing one way or another. And it's not settled yet, but they want to settle it. And that was enough for the market to say, all right, we can start looking ahead a little bit to when this thing is a little more put to bed. And we feel like there's enough room to keep growing here. That is my read on why the markets have done well since then. That being said, and not to get ahead of ourselves, because we're going to look at the past first and then the future, but this is the most pressing issue right now. That being said, there's no reason that I think, wow, well, I guess it's just all sunshine and roses and everybody should get into the market right now. Not really. We're basically telling everyone, and everybody's a little bit different. If you've done really well, we might be trimming, little changes there. But in general, we're telling people mostly stay where you're at right now. Don't buy in more, even though the market's done well, and you could say, well, am I missing out? Because we don't know where this conflict is going to go for sure. And that's one piece of the puzzle, obviously, a big piece. But there are other things. Inflation, which feeds from this conflict a little bit because oil prices impact that. But inflation's a concern. Where are interest rates going to go? All that stuff mixes together. And we say, all right, there's enough uncertainty now that it's not like a clear buy-in signal. But at the same time, I also don't feel pessimistic enough to say, you know what, let's take our money and run and duck, duck for cover while this thing gets sorted out. Because look at that chart since April, right? It's very possible for things to do just fine, if not well, while all this stuff is going on. So, it's not always the most satisfying. Sometimes I think people want to hear, no, it's we're either all in or we're all out. But right now, it's a classic stay where you're at. Don't get overextended, but don't pull back too much either. So that what I just rattled through right there is sort of this presentation in a nutshell. Now, don't log off. I've got more stuff to talk about yet. Um, but that is our general feeling about things right now. Markets are doing fine, if not good, right? So optimistic. The conflict is not over. That leans a little pessimistic. That to me says stay where you're at, stay in the middle. Kind of, you're not playing both sides, but you're diversified, right? So let me then go through kind of what underpins all of that. So first of all of the major banks every year, and this is a staple of this presentation, predict where they think the market is going to end the year at. And this number that you have on the screen, it's just a number. It's like the aggregate number. It's not dollars. It's just when the number goes higher, that means stocks have gone up. When the number goes lower, that means stocks have gone down. That's all you really need to know. Higher is better, obviously. So most of the major banks, um, predicted that the market would go higher this year. And it has gone higher this year. And the number on the screen that it closed at was 75.80. That was as of May. I can tell you right now, live this minute, 75.45. So we're basically at the same point it was at the end of May here in the middle of July now. That is above a few of the projections and well on our way to making these banks look pretty smart for the year. They seem to be about right from where their projections were. A lot of year left to go. I don't take any of their projections super seriously. It's just a good snapshot of how people are feeling. But it has been a good year so far. Now, here's the here's the kicker that I think gives you a little reason for optimism. I want to talk about the emotion here for a second. Maybe this is a good way to do it. Again, a million lines on the screen. I'll explain what this means. Most of the major Wall Street firms, or I shouldn't say most, a lot of them have kept their estimates the same. So in other words, by the end of May, did those same banks that predicted a good year for the market, did they want to change their answer? Right? So we're a little less than halfway through the year by the end of May. Did they want to change their answer? And more firms said, yeah, we want to change our answer. We think it's going to be better than we thought it was going to be. Versus only one, Wells Fargo, said, you know what, after May, we'd like to revise down. We don't think it's going to be as good as we did at the beginning of the year. So that goes to what I just talked about. We're in May, we're 2 months in to the war in Iran, right? By the end of May, we're 3 months into it. And more of these banks want to revise their forecast for the market upward than want to do it downward. And that speaks to optimism. So let's talk about optimism for a second. Right now, the average person is you can guess in your head. Do you think the average investor right now is optimistic or pessimistic? And the answer is overwhelmingly pessimistic. And I mean that very seriously. In June, and this chart is not in here, but I'll describe it to you. I'll put up just a blank screen behind me so I can describe it a little better. In June, there's an index out there called the Consumer Sentiment Index, which is just a survey that the University of Michigan does. It goes all the way back to the 70s, if not before. It's kind of considered in the economics world the standard for how are people feeling about the economy, just survey wise, right? It's not a hard data, it's just people actually get asked about it. That index, that survey, hit the lowest level on record in June, meaning people in June, and I don't know, it might stay there for July. I don't think the numbers are in for that yet, or even preliminary ones. But in June, the average person felt worse about the economy than they had ever felt in the history of the survey, than any group of people that were surveyed had. So, in other words, people felt worse last month than they did in the middle of the '08 recession. People felt worse last month than they did in the '70s with the gas crises and high inflation and low growth, than the dot-com bubble. I mean, worse than COVID as far as the economy goes, that's specific to the economy. And there's a couple things that I think we can take away from that. One is, and I don't want to call people's lived experience wrong because you're feeling that way for a reason, right? You're not making it up. That does not match the reality that we're seeing. Just on that last slide, you can see the banks don't feel that way. And I'm not saying the banks are always right, by the way, because they're definitely not. But the banks are feeling more optimistic than pessimistic. But if you are feeling pessimistic, you're not alone. More people are feeling more pessimistic than ever before. And I think there's a couple reasons for it. One, obviously, the news is making a big impact. The politics of the moment are making a big impact. Frankly, I think one of the reasons why people feel worse now, according to the survey, than they did in '08 is probably the prevalence of social media and these negative images, well, not just images, but these negative headlines get amplified and reverberate. And you see them over and over, and you can get caught in that cycle because of social media. And I think that can feed on itself a little bit. So I'm not blaming it all on that, but obviously there are things that are headwinds right now. Headwinds is kind of the fancy economics way of saying there's stuff we don't want right now. Inflation has been ticking up a little bit, so prices have been going higher a little bit faster. There have been major layoffs at some major companies, and I'm not trying to say that there haven't. Those have happened. You'll see a chart in a little bit where job openings have kind of spiked a little bit, partially because of layoffs. Now, usually layoffs are not, they're not firing you and then immediately looking for your replacement. They're eliminating the position, but there's a dynamic there. And so, not to say that everything's sunshine and roses right now. It's definitely not. But if you look at the underlying numbers, stuff that I look at every day, and you divorce it from the politics and all the noise out there, you do get a fairly good picture. And good meaning, hey, I think we're headed for growth here. And the fact that the sentiment is so pessimistic right now is as divorced from the numbers as I've frankly ever seen it. And again, that's not to say either one of those is right or wrong. Like I'm not saying just the numbers have to be right because they're the numbers. No, lived experience matters here. But I do think there's a pessimism that's taken hold that doesn't have strong foundations, is the way to put it, maybe. That doesn't quite match reality, that maybe is a little bit of pessimism for pessimism's sake. And I don't want, from an investment standpoint, that pessimism to kind of seep into our opinions here. Because we're trying to be very dispassionate about this. What does the reality, as best we can tell, say that might happen coming up? That's what investing is about. And I don't want to get bogged down in something that maybe is too pessimistic for the moment. So it's a fine line to walk because, if you're feeling shaken up about things or you're not, I'm not sitting here telling you you're wrong. I'm saying there is a distinction between how one feels about the economy and the markets and how they actually will perform. And no year before this year maybe has made that a bigger gulf, right? The markets have been doing really well. Everybody feels, and I'm saying everybody generalized, and everybody feels really crappy about it. That's weird, right? Normally those things kind of go together one way or the other, and the gulf is wide right now. So don't let the headlines color your opinions about the market more than they should, I guess is maybe the way to put it. They matter, but they don't matter maybe as much as it feels like they sometimes matter. And that's why we're not, even though people are very pessimistic, saying, "All right, everybody, duck and cover. It's going to be bad." No, it hasn't been, and we don't think it will be. Where there's just a lot of uncertainty, and that can cause pessimism too. So, thank you for indulging me with that little soapbox there. These are speedometers. We don't make these. These are by a company called City National Rockdale. It's in some ways their opinion, but this is sort of where are all the numbers pointing right now? And you'll see on the screen above my head. This is from last year, June 2025. I didn't get the wrong slide. We're going to compare this. So June 2025, everything's kind of in the middle, right? Some good, some bad. I would totally agree with that. There were some things that were in the red, and one of the big stories going into this year was that the market was pretty overpriced. Ironic that it's gone up since then if it was overpriced, but I'll get into that in a little bit. It's actually less overpriced now than it used to be, even though it's gone up. If you can get ahead of me and figure out how that's possible, gold star, but I'll explain it here. So let's compare that. By December of last year, so from June to December, hey, things are actually going in the right direction here. We've got some things better in the green. Geopolitical risk was actually trending better. Haha, surprise, surprise. In March, that changed quite a bit. But in December, things had changed. Now, the only thing that really got worse, a couple things ticked down a little bit, but that equity market valuation, which is just a fancy way of saying, is the market expensive right now? Is it high or is it cheap right now? Is it lower? And it was expensive in December. In fact, it was basically as expensive as the market had been since the dot-com bubble, which I was telling people that. And obviously that would make anyone nervous. Oh, you're telling me the last time that this happened where the market was this kind of overvalued, so to speak. That's one way to put it. That's an opinion statement, but overvalued was during the dot-com bubble. Oh, okay. That's interesting information. Maybe I should pull back a little bit. And we were very cautious going into the year. If you sat down with us, we end of last year going into this year, we're saying, hey, there's a big potential for a drop here, not necessarily a recession or anything major like that, but a market drop because of how high things were. Well, since then, you can look at the difference. Here's June 2026. So you compare it. A few of our greens turned to orange. So in other words, got worse, right? But a few the one I want to point out is corporate profit and that valuation again are actually got better for the start of the year. So in other words, we were expensive. The market was overpriced to start the year. It's higher now, but it's less expensive than it used to be. Now that doesn't seem on the surface when I say it like that should make sense. But so what changed? Well, when I'm saying how expensive the market is, what am I actually saying? What I'm saying is the price of the market versus how much money the companies actually make. It's a comparative thing. So there's two ways for the market to get less expensive. One, the prices can come down. That's the market going down. That's us losing money in the short term. It will come back, but in the short term, the market going down. That's one way. The other way is for companies to start making enough money to justify those high share prices. And what we saw this year, or really starting last year, was this big buy into AI, right? AI is everywhere. That was the big trend in the stock market last year, if not this year too. And everybody was buying in AI, 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 not just the companies that make, the AI bots that you could talk to, but all companies that are integrating it into their business and higher, higher, higher. Well, that kind of reminds you of the dot-com era too, right? Just replace AI with the internet. So made us nervous. What's happened so far this year, and it doesn't mean this will for sure continue, but what has happened is that a lot of those companies that bets were placed on by pushing their stock price up actually started to make money to justify those stock prices. That's why this line right next to my head here, corporate profit growth, and I know, corporate profits, okay, great. I'm glad they're making money. Corporate profits, good for them. I'm worried about my investments here. But corporate profits have a lot to do with how the market does. And they have gone in the right direction. And they have increased and that's allowed the market to become actually less overpriced without going down. That would be great if we could continue that. I'm not saying I'm predicting that, but if we get to the end of this year and the market has dropped as far as how overpriced it is versus without having gone down and dropping in value, that's a great outcome. So from that perspective, we're like, wow, we've had a really nice start to the year here, a first half of the year, frankly. This is the chart that talks about corporate earnings. You can see kind of that spike upward as 2026 has started here. It went flat for a little bit, went down for a little bit, and this shoulder right there is COVID. So you can see the big spike down, and then everything recovered. Go that way with it. And then it kind of lulled, and this was right above the top of my head here is inflation in 2022 and everything kind of dropped down again, and it's been picking back up. And that's really, if you're wondering what's been driving this market, why has the market done well? This is probably the only chart you need to see. Corporate earnings are up. And earnings are what stock prices are bets against, essentially. When you're buying a stock at a certain price, you're saying, I think the future earnings are going to justify this stock price. And so far, you've been right if you bought in the last couple of years here. Or if your funds that you're invested in, which are constantly buying and trading and things like that, have bought. So, in other words, the market's been a good bet, and this is why earnings are going up. And that, by the way, means we're spending more money too, because we're the biggest part of the economy. So it's things have been working in the economy. And that's again where that gulf between the pessimism and a chart like this really comes in. So inflation, let's talk about that for a second here. We're going to talk about interest rates in a minute, but inflation has been trending upward this year. You can see now, I don't actually, I don't like the way they did this graph. The one that's here, let me move out of the way. The orange one, maybe the yellow one too, but the yellow one's a little less egregious. They've made it look like, oh my gosh, look at the big spike in March and April here, right below my picture right now. And the magnitude of that spike is not as great as the picture makes it look because the picture kind of cuts off the bottom of the chart. So in other words, jumping from 3% last September when nobody was worried about inflation to 3.8% right now. Is that an increase? Yes. Is that oh my gosh, we've doubled our inflation rate? No, you can see the numbers right there. 3% to 3.8 is not, this graph almost makes it look like it doubled. Um, I didn't make this graph, so I'll blame somebody else for it. But the numbers are right. It just makes it look like the magnitude is even bigger. 3% to 3.8, is that an increase? Yes. Are we watching to see if it will continue to increase like that? Yes, that's very important. Does it go up from here or does it go down? But 3.8% in a vacuum inflation, which again, inflation is just how fast prices are increasing, that's not crazy. That's not a terrible number. We're not in a bad spot there. We're just watching the trend right now, is what I would say. You can see that, by the way, in the way month over month. So this orange chart on the left compares inflation to how it was a year ago. It was 3.8% higher in April than it was April 2026 as it was in April 2025. Simple enough. Month over month compares, okay, how much did prices go up from last month? Well, you can see in March, they went up almost 1%. Now, that's oil prices, right? That's the war starting in Iran, the strait being closed, oil prices bumping up. You can already see that that's slowing down here in April. So, in other words, we're not super concerned about this yet. This is not like oh boy, comes inflation. Everybody get ready. But it is worth watching. All right. And that's how I would phrase it. We're not to the point where I'm saying this is going to be bad, but we're watching very closely because it trended upwards in these last few months. Mostly, I would say, because of oil prices, which comes from the war. Labor market, without going too crazy or hog wild on this, this just measures what's the unemployment rate, which the unemployment rate is how many people are not working but are also looking for work. So if you're retired and you don't want to work, you're not counted as unemployed as far as the statistics go. Kids, like 5-year-olds, aren't counted as unemployed. So the thing to note here that I take away from this is look at that spike in job vacancies, right? The unemployment rate has stayed pretty darn steady there. And in fact, we basically, and it was true right before COVID, and then we got back there right after COVID, we were at 50-year lows in terms of unemployment, the unemployment rate, which is the number on the left here. We were under 4%. Now it's ticked just over 4% now. But that is an extremely low unemployment rate. The Federal Reserve, who has two goals right now. They have a goal to keep inflation low and keep employment high. They will tell you that they think 5% is a really good unemployment rate. Well, we're still around 4. So does that mean that layoffs aren't happening? No, layoffs have been happening. Does that mean that everybody who wants a job has the exact job they want? Absolutely not. Some people are underemployed, right? They're taking jobs to take a job, but maybe it's not a job they feel like they're overqualified or they're not making enough money. That's all real. I'm not saying that's not. But when you look at this, you're saying we've got a 4% unemployment rate. We've got somewhere around 6 million open jobs in this country still. So even if you do get laid off, there's somewhere for you to land. Maybe it's not as good, but somewhere. That's pretty darn good overall. Like we would take that in most circumstances. Compare it to where we were in the 2020s, obviously coming out of COVID, where we had a ton of open jobs, which created this low unemployment rate, and gradually those jobs have been filling, right? That orange line. So I say this to say the employment market, the labor market, I guess would be the better way to say it, is pretty good right now. Not perfect, and it'll never be perfect, but it's better than I think most people would guess it is right now. And that's another reason why the market probably continues to chug on while this pessimism is still out there. This is kind of just a fun one. It's pretty self-explanatory. How often are people talking about oil prices when these S&P 500 companies do their earnings calls and say, here's how our company did last month. Did they mention oil? They're all talking about oil now, right? That is the talk of the town in terms of will the strait be open? If it's not, what does that do to oil prices? If it is, but they're charging this, fee or whatever they're going to call it, Iran is. What does that do for oil prices? Because that's just going to get passed on down the stream if that's how it ends up working out. So oil is the big factor when it comes to prices right now. I don't think that's a surprise to anybody. Couple headlines. We've talked about a lot of this. So the strait's open, the strait's closed, the strait's kind of open. They're charging for the strait. I would, I shouldn't say I would bet. I would not be surprised if we don't get a full resolution on this is what the business operation of the Strait of Hormuz is going to be until September, October. There will be some natural pressure as we get into the fall to figure this out because as we get into the fall, the northern hemisphere obviously gets colder. And that's when fuel oil and all the different ways that that energy is used to heat houses or buildings or wherever in the northern hemisphere, the demand tends to go up. It's a different kind of oil, right? Demand goes up in the summer too because people are driving and that's gasoline. But oil obviously affects a whole range of different things just in and of itself. So I think there will be some pressure to figure this out by the fall because the Northern Hemisphere, which is Europe and the US and China, frankly, are going to need more of it. But that's just kind of reading between the lines a little bit. Inflation, is it going to continue to move up or is it going to kind of level off? So far, it's been okay. It's kind of leveled off. And then AI, well, we're going to have headlines about AI for the next 10 years here. There was a question that came through, so thank you. I'm reading it right now. What impact, if any, do you think the midterm November elections will have? Buy, sell, stay as you suggested. What should we do to prep for this? You were alluding to politics earlier, curious as to recommendations. Yeah, so this is probably a great time to talk about the midterms. There isn't a slide in here that says, well, if this party wins, buy, and if this party wins, sell. Because if you've talked to me about this before, you know my stance on how politics affect investments is, or the markets, is politicians and politics, no matter at any level, local, state, federal, president, affect the markets way less than they claim to. In other words, every time, there's a midterm, it's like, well, this election is really important for the economy, right? Because we have great ideas that are going to, that's what a party will tell you. And both parties will tell you that. So that's not even a political statement. Um, we have great ideas. We're going to make this economy work for Americans again. And then they get in and it's like, it seems like it kind of just did what it was going to do anyway. And if you feel like that, you're not wrong because the government is only a small part of the economy. We as consumers, we are 70 plus percent of the economy, which then affects the market, right? So I'm going to answer more of your question because I know you didn't just ask, well, if this party wins, what? But I think that's where people start a lot of times. Well, I think if the Republicans win, that's going to be good for business, so the markets will go up, so I should buy. Or I think if the Democrats win, they're gonna do this better, so the markets are gonna go up, right? Like people have those opinions. I don't think either party winning is gonna make the market or the economy do much that it wasn't already gonna do, is the way I would put it. But to your question in particular, what impact will it have? Well, in the short term, if it's a Democratic win in terms of even if they get only one chamber of the Congress, so House or Senate, certainly if they get both, but even if they only get one, you're going to see more deadlock, obviously. You're going to see more um, it's going to be harder to get stuff through even than it is now. And I would say that if the roles were reversed and the Republicans were the ones out of power and they were the ones kind of on the upswing potentially. The polls seem to continue to say the Democrats are going to pick up seats. I think, that's just a reality. Like, I don't have an opinion on that as far as investing goes, but I would see if that were to happen, more gridlock, less gets done. Now, in some ways, the market likes gridlock the most because they know that no big change is going to come through. Um, that doesn't mean the markets are going to do poorly. In fact, I think a split House and Senate might be what the markets want because then they know, all right, every change is going to get fought over tooth and nail, and they're all going to be little incremental things. So we're not going to have to worry about a brand new tax regime all of a sudden, right? Um, that I think the impact is going to obviously be more political than investing wise. I don't see right now an outcome out there that makes me think, oh boy, this is really going to tank the economy. Even if it's the clean sweep one way or the other, like the Democrats take both the House and the Senate, or the Republicans have both the House and the Senate, and still the White House, obviously, because it's not a presidential election year. I don't see that making a gigantic difference in and of itself. Obviously, they can enact policies that do make a difference. I just don't. Nobody's really announced like, hey, if we get in, we're doing this, and I'm looking at it saying, ooh, wow, that's going to have a big impact. So That's the long answer. The short answer is I would stay how you're at. I would watch the Iran stuff more than the politics. Obviously, the politics matter, but more for on the political level than on the business level. There was one other thing I was going to say about that. Oh, which is in November, our monthly event, this is our monthly event for July. In November, our monthly event is going to be a reaction to the midterms. So I guess we can pull this clip up of me talking about it right now and see if I still agree with myself in November after the election's done. But we will be doing, you'll all be invited to it through the same channels you're invited to this one, but an election reaction, more or less, from the perspective of the economy and business and investing. So look for that in your inboxes. Okay. Um, so what are we looking for the rest of this year here? Obviously, the election is one. What are the expectations? The expectations are that we probably continue to do well. Um, the dotted line here is where the projection, or sorry, that's what the market's already done so far this year. But earnings are expected to still be, excuse me, still be good. That in a nut that in a not in a nutshell, in a vacuum, if that continues, it should do well. Now, the reason why I'm still not pounding the table and saying, all right, everything looks good, let's buy, is because of the risks around the world of inflation, of oil, of this Iran conflict. And, who knows what other risk is going to pop out of the woodwork that we're not even thinking about right now. I still think it's a little too volatile to say, no, it's definitely going to be good. But let me put it this way. Maybe this is the simplest way to sum it up. If the war in Iran had not happened, if we had just been living through this year as it was, but just remove that whole part of the equation, and I know you can't, but if we could wave our magic wand, it would probably be a buy right now based off all the underlying numbers, saying, yeah, it's actually time to stick a little more money in the market if you can afford it. When I say a buy, I don't mean for everybody because some people are already as aggressive as they should be. But just if you've got the money, if you've got the capacity of buy-in. But the Iran stuff has pumped the brakes on that. So that's why we're kind of in the middle right now. Maybe that's the simplest way to put it. So projections, where will corporate earnings grow? Energy potentially will be a big factor here. You can see they're all projected to grow, other than perhaps healthcare, which is its own animal. But these are all the individual sections. Did have a quick question come in. What about the temps in Europe? And I'm assuming you're talking about now, where it's been very hot and they've been having a lot of problems with heat over there, as opposed to the winter where it can get cold and then they have to heat their houses somehow. Um, you know, there's been a lot of talk this summer about the different, I guess, philosophies that the United States and Europe have when it comes to the heat. They're just not as used to it over there as, Minnesota here, we get hot, right? It's been hot these last couple weeks in Minnesota. A lot of us have air conditioning. A lot of us have buildings that we can go to with air conditioning. We can weather it, right? Or we can go up to the lake or something or somewhere. Europe, they don't have that infrastructure. So actually, when you talk about temps, where my head goes is less about this energy issue and how Iran affects it. I'm thinking of how many more years are they going to go without widespread cooling infrastructure, right? How many more years is it going to be? Well, we have this little portable AC in our house that vents out the window essentially, but that's, what we're heating our or our cooling, in this case, our entire house with. And to me, there could be an opportunity there for, I don't know what company, I got to do a little research here, but what company or companies or industry is going to come in and say, all right, Europe, you have the appetite. Let's fork over the cash and let's put AC in your buildings now. And the companies or the industries that are able to capitalize on where I think that's going, that could be a big growth opportunity, right? These manufacturing or industrial companies that are maybe retrofitting old buildings with air conditioning, ventilation, HVAC. That could be a big opportunity for investment here, frankly. Yeah, it's probably a little early right now, and we need to see where the landscape goes, but that's honestly where my head goes on that. I see the opportunity there. I don't see a big downside for U.S. investors based off of that. All energy needs are going to just continue to soar, essentially. So does that go back to oil? Yes, because that's where a lot of energy comes from. But ultimately, I think it's more of an energy question than an oil Iran question. So I'm reading into your question a little bit, but hopefully that kind of answers what you were getting at. Um, What's the economy going to do this year? These charts are surveys. I believe they're surveys. Forecasts are based on assumptions and subject. Eh, well, this is the Federal Reserve. So I guess this is the Federal Reserve of Philadelphia's projection, not just a survey. And the point I would make, let me boil this down real quick. The chart on the left, how much is the economy going to grow this year? Most people, or the probability seems to say between 1.5 and 2.4%. So call it two. That would be, I'd take that. That's good. That's good. 2% doesn't sound like a lot, but that's kind of what our average has been for a long time. So very average year growth wise is what most people think. What's unemployment going to do? Most people think it's going to be, again, it's in a survey. The Federal Reserve thinks it's going to be between 4.3 and 4.8%. That's a little bit higher than it is right now, but that's still fine in the grand scheme of things. So that'd be fine. What is inflation going to do? That's the chart on the right. PCE is a personal consumptions and expenditure index. I think I got that acronym right. It's inflation, essentially. Most people, or not most people, the Federal Reserve of Philadelphia thinks it's going to be somewhere between 2 and 3%. That would be great. And so, in other words, if this forecast, which is from the Federal Reserve, comes true, I'll be very happy with all these numbers. I won't have much to complain about with these. So that would be great. And that is what they actually think will happen. It's not just an if statement. That's what they're predicting right now. How long will inflation stick around? So I've seen, not to turn this into a soapbox, and this is me putting on my economics hat, or I don't know, clip-on tie would be the appropriate item of clothing for an economics person. But you may know, I've said it before, I went to school for economics. So this is inflation and all these economic indicators. That's my bread and butter. And I have seen a lot in the media, not from individuals, but in the media, a lot of misinformation about prices and so-called sticky prices. Okay. Because I've seen people out there call it, well, it's sticky inflation. Inflation tends to stick where it's at. It doesn't move very much. That is not true. Let me explain what you'll hear sticky prices every once in a while. That's a concept, and it makes, once I explain it, it's going to make total sense. Is once you raise a price, you don't necessarily tend to lower it very often, right? Once eggs are certain, and food is kind of a bad example because food can bounce around in price. Like gas is a bad example. Gas does bounce up and down. But you go to the gas station and you get a soda from the cooler. Once that hits $2 for a bottle of pop or whatever, that's not going back down to 150. Just because inflation has gotten lower, right? Maybe they'll run a special every once in a while, but think about your lives. What did you used to be able to buy things for? What can you buy them for now? They don't go back down once they go up. That's sticky prices. One of the classic econ examples is a restaurant menu, right? Once they print up those new menus with the new prices on them, to change their price, they got to reprint a menu. Well, they're probably not doing that if it's going to lower the price, unless all of a sudden they've upped their prices way too much and nobody comes there anymore, right? Generally, once you get those increases when you're out to eat or wherever, they stick. That's sticky prices. What is not sticky is the inflation rate itself, which I've seen on the news a few times. Some people say that, and I'm like, no, 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 no. The rate at which things go up in price is not sticky. That can be really high one month and really low the next month. It depends totally on what's going on out there. So I say that to say, other than to get that out of my system. I say that to say, just because inflation is ticking upward or maybe a little higher one month, doesn't mean it's going to stay there the next month. The inflation rate is just how fast things are changing. That can easily slow down depending on what happens in the economy. We don't see it at this point at a dangerous rate. We're watching it very closely, is what I would put to you for it. And inflation then affects a big part of investing, which is interest rates. Not just investing, but all of your lives. Interest rates are if you want to buy a new car and you finance it, that's an interest rate. If you obviously are changing, you're buying a new house and you need a mortgage, that's an interest rate. You're taking out a line of credit, that's an interest rate. And up till this year, up till Iran, basically, we were on a path where rates were slowly, gradually being cut, right? And that was why the Federal Reserve was in the news prior to this year was President Trump was saying, I want them cut faster than they're being cut. And the Fed's like, we don't really want to cut them faster because we don't want to, let things get out of control. By the way, I agree with the Federal Reserve there. I think they were on the right pace. Then Iran happens and they pause. And rightfully so, by the way. In fact, in May, I want to say, I could be getting the month wrong, but the point is right. The chair, the old chair, Jerome Powell, there's a new chair of the Federal Reserve now, but he was doing an interview and he said basically, we're waiting to see what's going to happen in Iran before we decide what to do with interest rates. And I was like, music, well, not music to my ears, but that's exactly what I'd been saying to people too. So I was like, well, great minds think alike, hopefully. Um, we believe at this point, rates will probably continue to go down from here. But for the short term, they're probably going to stay the same because they're waiting to see what happens in Iran, just like we are. The thing that would make me nervous, I don't like talking about worst case scenarios, and maybe this isn't worst case, but a thing that would make me nervous would be if inflation stays higher, and I mean, we're going up to like 5% here, not just 4%. But if we start getting to 5% inflation, I think they're going to have to start thinking about raising interest rates. Now, you may not remember off the top of your head the last time they raised interest rates, but you felt it in your investment accounts because it was 2022 was the last time they raised rates to combat inflation. The markets had a bad year in 2022. Bonds had a bad year in 2022. That's the first time I've mentioned bonds today, which is a big part of most of your investments. That might be half your account. Bonds don't do well when rates go up. In fact, there's actually a slide about that. So as they raise interest rates, the prices of current bonds goes down. That hurts all of us that own current bonds. So if, and this is an if, and I think it's less likely, but it's possible, if we start to believe that inflation's going up, they're going to have to start thinking about raising rates. Expect to hear from us about your bond part of your portfolios. In other words, we're going to want to probably make some changes for everybody there to kind of prevent a downside from happening. Now, this is an if. This is not even a prediction. In fact, if I were to predict, I think we probably avoid that scenario, but it's certainly possible. So don't be surprised if inflation stays higher that you hear from us about the bond part of your accounts. We're prepared for that circumstance, even if it may not happen. All right. As always, stay focused on the fundamentals. This is kind of I don't like the way that they visually did this, but there's orange squares here and then there's gray rectangles, right? The gray is the down periods we've had since 1970. The orange are the up periods. What do you notice? Forget about the numbers. There's way more orange than gray. Okay. There's way more orange than gray. The market does do well, even throughout a lot of instability here. In fact, coming out of 2008, we had one of the best markets we'd ever had in terms of upward trends for, basically a decade plus. That doesn't mean that, okay, we had our 2022 and our COVID drops and now we're on pace for another decade. Doesn't mean that for sure. But it would not be crazy if the market continued to go up for another 5 to 7 years. I'm not saying I'm predicting that. I'm just looking at the history of it. So, what I bring it up to say, sometimes people say, well, the market's high, and that probably means it's going to go down again, right? And I'll say, well, it is going to go down again at some point for some reason. But just because it's high doesn't mean it has to go down. Look at these periods right above my head here. This is the 90s basically since from 87 through the dot-com era, up for 12 years, up 500%. Here's post 2008, right above my head, right there, up for a 400% for 11 years. These runs can continue once they start. I mean, we have some good example of that. They don't have to. I'm not predicting that, but don't just think because we hit a new high that it has to go down. That's not how the market works. That's what I like to bring up. Okay. So in a nutshell, and if anybody has any more questions, please type them in the chat. In a nutshell, we are not, I wouldn't call us bullish on the market, which means optimistic. Bearish is pessimistic. I would call us uncertain right now. The underlying numbers are pretty good, average to good, I would say. The circumstances, so the geopolitics and what's going on in the world, that's where all the uncertainty is coming from. If the geopolitics stuff gets cleared up without a major negative impact one way or the other, we're going to go back to the numbers and say, well, the numbers look good. So now we're more positive, we're more optimistic. Because of the uncertainty, we're recommending people mostly stay where you're at beyond, little trims here and there, depending on the person. Um, but if the uncertainty grows over here, then we're going to start thinking more pessimistically. So we're in a kind of a fluid position, which usually the best advice I can give you when we're in kind of a fluid situation is stay where you're at. Because sometimes going either direction can be not maybe not a mistake, but a misstep, let's call it. So we're just about at the top of the hour. Does anybody have any further questions? Next month, we're going to be going over just 5 mistakes we're seeing more often in 2026 for retirement. It's sort of a broader thing, but it gave us an excuse to kind of talk about some current events that aren't just market related. So that's what next month's will be when you get the invites. I haven't seen anything come through. If you're in the middle of writing one out, as always, just email us or get in touch with us. Our contact info is on the screen, obviously. And everybody, stay cool and have a great rest of your week. Thank you.